Welcome back, focused learners. Let's jump right into today's explainer. We're unpacking a massive, data-heavy market update from May 4th, 2026. And let me tell you, this specific batch of data is just full of wild contradictions and mixed signals that literally impact your personal wealth, your borrowing power, and the broader economy. If you've been feeling like the economy is sending you totally mixed messages lately, well, you're definitely not alone. Let's look at exactly why that is.
Here's our roadmap for today. We're covering Fed rates and rising inflation, climbing home values, the housing construction puzzle, economic growth and jobs, a sweet family hack, and finally, what to watch next. Let's dive in.
Section 1. Fed rates and rising inflation, the macro tension.
Okay, so on one hand, we've got the widely anticipated consensus, right? The Federal Reserve left its benchmark federal funds rate completely unchanged at 3.50 to 3.75%. That's their third straight meeting doing absolutely nothing. But here is the real story. 4 officials actually dissented from this decision. That's the highest number of dissenters we've seen in decades. You literally had one official wanting an immediate rate cut, while others were pushing back hard on even hinting at any future cuts. It just shows a central bank that is deeply, deeply divided on what to do next.
And this brilliantly illustrates why the Fed is so stressed out. Just look at the March 2026 headline PCE. It spiked to a 3.5% annual rate. That's up 0.7% month over month. Why? Well, it was mostly driven by a massive surge in gas prices tied to tensions in the Middle East. Meanwhile, core PCE, which remember is the Fed's preferred measure because it strips out the volatile stuff like food and energy, that's rising at a much more moderate 0.3%, putting it at a 3.2% annual rate. This huge gap between headline and core, it perfectly explains all that hesitation and division at the Fed.
Section 2. Climbing home values, the wealth effect.
Now, what's incredibly interesting here in the Case-Shiller data is that national home values edged up another 0.1% month over month after seasonal adjustments. Guys, this marks 7 consecutive months of gains. Year over year, we're looking at a 0.7% increase, but if you look at the recent trend, it's putting us at roughly a 3% annual pace of appreciation. So despite everything going on with interest rates, home values just stubbornly keep climbing.
So, what does this actually mean for you? Let's anchor this right to your wallet. If you take that 3% annualized gain and apply it to a typical $500,000 home, that translates to adding a very tangible $15,000 in wealth over the course of a single year. It's wild, right? It just powerfully underscores the long-term wealth potential of homeownership, even when the economic climate is this confusing.
Section 3. The housing construction puzzle, the builder's dilemma.
Builders are sending us totally mixed signals right now. Just look at this stark juxtaposition. Housing starts, meaning builders actually breaking ground and pouring concrete for new homes, rose by nearly 11% from February to March. They were out there digging dirt, probably taking advantage of some better weather. Yet, at the exact same time, building permits fell by that exact same margin, 10.8%. So they're building what's right in front of them, but they are dramatically pulling back on the paperwork for future projects because they're just so uncertain about the economy.
And when you follow the overall pipeline activity, from permits down to starts, under construction, and finally completions, that 10.8% drop in permits on the far left, that's our earliest leading indicator. It tells us that while there's a flurry of activity right now, we're talking 1.5 million annualized starts, builders are proceeding with extreme caution when it comes to committing to stuff down the line.
Section 4. Economic growth and jobs, the under-the-radar economy.
All right, the first estimate for Q1 2026 GDP shows the economy growing at an annualized pace of 2%. That is a really solid bounce back from Q4's super sluggish 0.5%, which, if you remember, was dragged down by government shutdown. This new growth is being driven by massive investments in AI and a big rebound in government spending. And on the employment side, get this, initial jobless claims actually fell to 189,000. That is remarkably low. It begs a fascinating question. Are these jobless claims persistently low because unemployed workers are just turning to uncounted gig work? Honestly, it's very possible there's a whole layer of the workforce that just isn't being captured in these traditional figures.
Section 5. A sweet family hack, strawberry peach crumble.
Okay, let's take a quick breather. In honor of National Strawberry Month, here's a fun, data-driven family hack for strawberry peach crumble. Step 1. Whisk your lemon juice and arrowroot flower binding agents together. Step 2. Integrate your core assets, 1 pound of halved strawberries, 1.5 pounds of sliced peaches, and a half cup of brown sugar.
Step 3, pulse your topping ingredients. That's the flour, oats, almonds, sugar, cinnamon, and chilled butter until it resembles coarse crumbs. And finally, execute the bake. Pop it in for 40 to 45 minutes until lightly golden. It's literally the perfect sweet break to reset your attention span before we dive right back into the heavy numbers.
Section 6. What to watch next. Looking ahead. So we have a ridiculously busy upcoming week of crucial economic indicators that are going to give us the next puzzle pieces for the Fed. On Tuesday, we get new home sales and job openings. Wednesday brings private payroll data. Thursday offers the latest weekly unemployment claims. And the whole thing culminates on Friday with the highly anticipated broader jobs report featuring non-farm payrolls and the official unemployment rate. This timeline is basically what every market analyst is constantly refreshing their screens for right now.
Briefly wrapping up our data analysis with the technicals, mortgage bonds are currently testing a really stubborn ceiling right around 100.61. If they fail to break above that, we could easily see a drop down to the support level of 100.35. At the same time, the 10-year Treasury is bouncing around in a pretty wide channel, holding support at 4.33% and hitting resistance near 4.48%. These are the rigid boundaries traders are watching super closely to see exactly where borrowing costs are headed next.
Which leaves us right here. With headline inflation rising due to global tensions, a deeply divided Fed, home values stubbornly creating wealth, and a labor market that might just be masked by a booming gig economy, are we headed for an economic breakout or a breakdown? Can resilient homeowners and a hidden gig workforce outlast the Fed's inflation battle? I want you to weigh these signals, ponder that exact question, and definitely keep a close eye on Friday's numbers. Thank you so much for joining me on today's Explainer, and as always, stay focused.